Welcome to the Aquest Podcast, conversations about regs, funds, and governance with your host, Daniel Lawler.
This is the November 2018 edition, which is the 1 year anniversary since the launch of Aquest, which we'll touch upon, I think, a little bit in today's conversation with my guest co-host, who is Adrian Mulryan. Adrian is a fellow lawyer by training, a fellow entrepreneur in the funds industry, and an ETF expert. Is that fair enough, Adrian? Have I misspoken there?
Serial entrepreneur.
Better again. So give us a little bit of intro for yourself, Adrian, a little bit of backstory.
A bit of background. So as you say, I'm a lawyer by training. I started my career in the late 90s, which gives my credentials as to grey hair. Was a funds lawyer in Dublin. Saw the bright lights of London, moved to Allen & Overy, and ended up, through a quirk of fate, heading up retail issuance for a Dutch bank, ABN AMRO. Which was my exposure to crisis. That was my first attempt at blowing up the world. My second attempt at blowing up the world. My first was whilst at Allen & Overy. I was a CDO and synthetic credit lawyer. So basically everything that went pear-shaped in the crisis, I had a hand in.
So you have a lot to answer for.
I have a lot to answer for.
How is your PI policy? Is it
expensive? But on a serious note, within ABN AMRO, in 2005 we started to build an ETF platform, Market Access. And then Market Access became quite successful quite quickly. And then that brought the platform and some of the people involved to the attention of Goldman and Morgan, who were setting up a joint venture which became the Source business. And I was employee number 3 in there in October of 2008. And we spent a lot of time flying to Dublin in 2009 on planes, building out that platform when there was nothing else going on in the world, because it was a very, very quiet time.
That was a lonely time, all right.
Yeah, for the first couple of months, you'd go to City Airport, and there'd be 7 people on the flight. There'd be myself and 6 guys from the IMF. And then as time would go by, another 6 months would pass. You'd have myself, the guys from the IMF, and then the hedge fund guys would be on the plane. But you could see the economy during that period. We were into Dublin once a month. You could see the recovery coming, because by the time 2012 came around, the flights were full again, and everyone was going to instruct someone, and everyone was going to do business in town. And I think it was quite interesting. I probably saw the recovery here before anyone else on the ground did, because you had this kind of bird's eye view just of travelling in and out once a month to see how things were improving, albeit slowly. And
you moved from there back into Dublin at some point?
Yes, so the Source business sold out to private equity in 2015. At which point we had built it, grown it, sold it, and I decided in my infinite wisdom that I wanted to return to law, and had a fabulous time working as a partner in Arthur Cox in the funds group. Some excellent clients, some great exposures, but to some extent, from where I had come from, slightly frustrating. Not the law firm itself, not the practice, but the clients. You ended up advising the clients more on how to build their business rather than actually just building the technical legal box to allow them to launch ETFs or to launch funds. And my new business, marketβeta, founded by Graham Dewar, who's ex-Legal and General, he came into me as a client first of all, and we kind of shared the same frustrations around how managers were actually, they were building boxes but not understanding how to actually get their costs right, not understanding how to get their distribution effort right. And marketβeta was kind of born out of trying to take people who had done many successful businesses with multi-billion of AUM and see if we could apply the lessons that we learned to large-scale organisations that wanted to get into the exchange-traded fund space.
So we'll talk a little bit about maybe the more technical side of ETFs and legal and reg and trends and that kind of stuff a little bit later on. But talk to me a little bit about what exactly it is that marketβeta does, what it offers to clients that they get from today to new ETF on the market.
We're a high-end consultancy, and when we launched, we all had worked in various organisations. So the one thing we understood is that every organisation, that funds companies are 2 things. They're a brand and they're operations. Funds companies, number 1, undervalue their brand, and number 2, their operations are born out of 20, 30, 40 years of sticky plasters and bad practice. And rather than trying to launch a white label organization to service these companies in launching ETFs, we wanted to go into large scale managers, 50 billion euro plus of AUM, who didn't have an ETF offering, sit down with them and say, look, if you want to get into this space, and there are very good reasons why you should, here's how you should do it. And your problem is not whether or not you will be successful, because you have a brand, you have track record, you have many billions of product. You fundamentally have to understand why you're getting into this space and how to right size your cost base and how to build an infrastructure model that would allow you to compete not only in the ETF space over the next over the next decade, but also in the increasing competitive world of funds and price competition.
And why aren't these guys in ETFs already?
Very good question. For most of them, they stood back for a long time and said, it's just a wrapper. I'm not interested. My clients aren't clamoring for it. It's not a business I want to get into. It's carved up between a number of big players. I don't see any need for me to get into chasing fees downwards. And they stood back. And there's only so often you can stand back. And year after year, I think last year, one of the reasons I joined marketβeta, and one of the reasons that we kind of pushed ahead this year, is that last year was a transformational year. There was 100 billion of inflows in Europe into ETFs. There was 100 billion of outflows from active. Now, that's not directly correlated, but it's certainly indicative of a trend. And people are realizing that for a lot of managers, they got very, very comfortable. If you had 30 billion sterling of AUM and you did nothing year on year, you ended up with market move and legacy inflows, you'd end up at 32 billion and you'd move on from there. So a lot of these guys didn't really have to worry about these things, but now people are understanding it's about scale, it's about quality, it's about cost, it's about efficiencies, and it's about becoming that trillion manager. The new marker now for managers over the next decade is who can be in the trillion club. And that seems to be, some will do it through merger and acquisition, and others will do it through very rapid growth.
And what kind of product are they looking to bring? Are they taking existing product and wrapping an ETF around it? Is it all index product?
It's a combination. So a number of them, and most of them rightly, don't want to get into the passive big benchmark game, the S&P 500s, the FTSE 100s. That business is gone. For others, they're taking a strategic look, because clients are coming to them now and saying, look, you've got a managed account platform for me, you've got a unit trust platform for me, you've got this UCITS product for me, why can't I have an ETF? And a number of them are now saying, okay, it actually is the right time for us to start putting that product on the shelf. Also for active managers, a lot of active managers saying, okay, my active strategies aren't really suited to ETFs, and they're probably right. For transparency and other reasons, they probably won't work. But a number of them now saying, hang on a second, I have a lot of IP and value. I have IP and value in my brand. I have IP and value in my star managers. Can I come up with a concrete proposal around how I take that IP and make it a sub-brand, or make it something that my clients will actually find useful for them as part of their portfolio? And this is the piece, again, most people are finding, is that in the post-RDR, post-MiFID world, that asset managers, or more to the point, IFAs, investment advisors and family offices are looking at blended portfolios of product across a series of price points. And they realize that if I'm only at one end of that portfolio, I can only ever get into 20% of that portfolio. If I make my product suite match what the advisor is putting in, then I've got a shot at getting into 100% of the portfolio. And that's certainly coming through.
And so is it from a distribution point of view or an asset gathering point of view, is it about keeping existing money and keeping existing clients rather than necessarily looking to win new mandates? Or at least to start off with? It's
both. We've heard from one manager who recently lost out on a pitch for new business because they didn't have an ETF offering, and that changed their view. Suddenly it was, if nothing else, a checkbox. But there's much more to it than that, because you're looking at where the development of distribution is going, and distribution is key. And when you look at the ETFs in Europe, it's not a slam dunk. There's a long list of what you would call failed managers in terms of distribution. But if you look at where the market is going from a technology standpoint, when you look at the growth of platforms for distribution, and you look at some of the more positive attributes of ETFs, an ETF is just a fund. There's no killer application in it, but when you combine all the attributes of it, it does become something which is increasingly more saleable into institutional as well as retail lines.
And are these clients setting up their own ETF then? They're not necessarily taking a white label option and or are they?
A combination, and again, white labeling is something which works for an awful lot of people. If you're a smaller scale US manager and you want to come to Europe, white labeling works. Now, white labeling came from the US, and like most things in the US, is either tax or regulatory driven. The white labeling in the US grew out of, if you wanted to launch an ETF, you had to have exemptive relief. Only certain managers had the relief. So going on a platform meant you could launch product quickly, more efficiently than trying to apply for your own exemptive reliefs. That spurned an industry, and they're now comfortable and familiar with white labeling. In Europe, it's slightly different. And if you're a big manager and a big brand, you want to retain control of your IP. You want to control your complexes. You want to control your boards. For some of them, there's too much risk involved in white labeling, and it doesn't necessarily. The problem with white labeling is not getting to market. Is if you're successful, it's how you decouple from the white label solution. So what a lot of people are doing is they'll build their own UCITS complex. They might bring in service providers all around that to provide the kind of the ETF piece to them. But certainly it's an option for people.
Yeah, I found talking to clients not so much about white labeling ETF funds, but for example, looking at Manco options, and if you mention a third-party Manco, some clients, it's a bit like Marmite, some clients are into it and they're open to the idea, and some clients, you won't get to the end of the sentence and they'll have shut you off. They're just not interested. So it seems to...
Yeah, part of our business model was to look as to whether we built our own Manco. And actually, because of the clients we have and because of the space we're in, everybody has their own Manco. They're not looking for a Manco solution. So you're building something just to have it on the shelf, but it's not actually getting dusted down. And all of the large scale players, and they say we're in a spot where we're talking to a lot of very, very large people and working with a lot of very large people, and they they have the infrastructure. They just don't have the institutional knowledge as to what's the secret sauce of an exchange traded fund. How do I actually build my organization around it? And again, a lot have found that their cost base is wrong, and that a legacy manager, if you plug an ETF into a legacy manager, it will fail. You almost have to build it as a fund complex within a fund complex, where you give it its own cost lines, you give it its own base, and that allows it to be as successful as possible.
And is it expensive then for their low cost funds and their ETF is a wrapper around a fund? It's not a product in and of itself, but there is, as you said, a secret sauce to it. There is a bit of genius to how the whole thing sits together. And so does that make it quite expensive to get your first one over the line?
Absolutely. And what people don't get is that on paper, ETFs are more expensive than vanilla funds. You have the cost of market making, you have maintaining listings, you have a different marketing approach. There are additional costs in there that you do not have over a vanilla fund. And that's why there's been a lot of head scratching from the traditional asset management community. Why would I go into a business which is more expensive and the fees are lower? And it is because ETF providers have built a better mousetrap. And if you look at some of the leading players out there, what they have done with their ETF businesses is they've actually pushed what they've learned from managing, running and operating ETFs on a tight basis to protect margin, and they've brought those lessons and technologies into their broader asset management business. So in a world of falling total cost of ownership, they're insulating margin, which is allowing them to grow and protect their business.
So is ETF business then a loss leader? Is there profit to be made? There's
absolutely profit to be made, but there's greater profit to be made in actually taking the ideas surrounding an ETF business and bringing it into a broader asset manager, where you ring fence yourself for the future by having by having a lower cost business. And it's becoming, asset management is becoming a volume business, and you just can't charge for the sake of charging anymore. And people have learned that, and the ETF businesses are practiced at providing quality product at a lower cost, whilst yet maintaining margins in what they do and ensuring ultimately that they're profitable.
So one of the things I say a lot in my post-regulator days when I meet clients or doing training sessions or whatever is, if I were a regulator. So if I were a regulator and I looked at ETFs, one of the things that would maybe concern me is the proliferation of ETFs, and as more and more providers get involved, there is a skill set to running ETFs and running them well, and managing market makers and liquidity and that kind of stuff. How do new providers address that? How do you make sure that they don't fall foul of just not having the skills there, and next thing the fund seizes because the liquidity isn't there and the investors lose out? Is that managed, or do they buy in talent, or did they train up talent, or how do they make sure they have the knowledge?
It is absolutely managed, and everyone is actually ensuring that they have the right talent within their organizations. And a combination of buying in, and a combination of training up, and a
combination of hiring you guys,
and a combination of taking us in to actually fundamentally build the business, the process, the staffing levels and allocations to ensure that you have a very robust, sustainable business. And I always say to regulators, people look at ETFs and say, well, they're lower cost, therefore there must be higher risk. I say, well, actually, no. Look at traditional fund management, and you have to ask the question, why are they high cost, and how are investors' interests being served by being in these higher cost legacy products? And you'll find the investors' interests are not being served by the higher cost legacy products. But what we're finding is we're getting to a balance now where it's not all about price, thankfully. People are understanding that there are benefits and costs of different product types, different asset classes. There's now a better blended pricing. And I actually think what's going on now is that people are not cutting costs. They are actually fundamentally restructuring and right-sizing their businesses and using technology to ensure that they have a fundamentally better system for running an asset manager, as opposed to just putting a sticky plaster on an operations model that worked 10 years ago but doesn't actually work today. We all have the anecdotal stories of guys receiving in PDF files, then printing them and having a guy in the basement who's inputting the numbers on the PDF into the system. Asset managers have had to and are becoming much more tech savvy and much more automated and much more process driven, which is actually fundamentally reducing risk in the industry.
Sounds like it's a maturing industry then, and this is what happens as you get more used to running a particular product suite. And
absolutely, and if you look at asset management as the last bastion of an absence of kind of price competition. You look at the airlines, you look at the supermarkets, their operating margins are tiny compared to the asset management industry, and is now coming to the asset management industry to justify their existence and justify why they're charging the fees they're charging. And some are very, very good at what they're doing, and they're charging fees. And I personally am very happy to pay 1%, 1.5% to some managers. I'm less happy to be paying 60 basis points to someone for what I determine to be a vanilla exposure that I can get somewhere else for 10, 15, 20 basis points. And it's the more educated investor as well who's pushing back on that, because the market returns aren't necessarily there. So you look at every aspect of your portfolio and say, okay, what's working for me and who's working hardest for me, and who's being rewarded, and am I happy with them being rewarded?
Well, price competition, obviously, that piece of regulatory work is, this part of the world anyway, really been driven by the UK, probably the first instance, the FCA, because they actually have a competition mandate as part of their organisation, whereas over in Ireland it's not part of the central bank's mandate, but you still see questions around things like closet index trackers and value for money are starting to appear here as well. And also we tend to be a net taker of developments in the UK that kind of that wash back into this market. But the best example I give is the RDR, the Retail Distribution Review carried out by the FCA, which had a knock-on effect of a lot of IFAs in the UK. You had thousands of IFAs who just realised the amount of work they had to do to comply without getting trail commissions and actually justify their existence and charge their clients. A lot of them actually wound up their business and merged with other providers, and they all hubbed around a technology solution. They all hubbed around one Salesforce type database, and they rebuilt their business model, and the clients are now better served by a single larger institution that's much better managed and much better run at ultimately a lower cost to the end client. There is nothing but upside to that. So clients are in a better position.
Absolutely.
Happy days. Let's talk a little bit about regulatory developments and regulatory landscape for ETFs. And I suppose the natural place to start for that for us is probably the central bank's discussion paper and then feedback statement. What's your take on that whole process? Not so much the outcome, but just as a body of work.
I think it was an excellent piece of work, and actually it's become a sort of a thought leadership piece globally now for regulators when looking at exchange traded product. Nobody had pulled together such a comprehensive paper before, which dealt with every aspect of the product lifestyle, from market making to APs to distribution to builds to product types to technology to transparency, and it was very interesting to see the process in terms of how that evolved. I think ETFs is one of those areas where it's still a very new industry, relatively speaking. Those who are in it are still relatively new, and it has a relatively clean copybook. It has never had scandals, shall we say, in the regulatory space in terms of fees or in terms of things which have caused regulators to rap an industry on the knuckles. And if you go back to 2012, when we were looking at synthetic structures, there was a great openness in the industry towards the regulatory community who came in and who looked at that space, and we've kind of carried that openness on. I think everybody understands where the push points are in the industry from a regulatory and industry standpoint. I think they were aired well. There was good questions asked. There was very good responses put in, and the end result was a very, very considered response to it, which some positives for the industry in terms of developments on share classes, for example, which we may come to again. I think is definitely a huge opportunity in the next number of years. Disappointment around transparency, but that's an ongoing discussion and that's an ongoing debate. But overall, very well received.
Yeah, well, let me declare my interest here, because I did work in the central bank at the time the paper was drafted and issued, and it has been very well received by industry. I think it was nice as a regulator to get ahead somewhat of developments rather than to be reactionary, which obviously post-crisis, particularly more regulators in the modern industry generally were reacting to new legislation and what have you. But the ETF piece was an opportunity to take, as you said, something where there hadn't been a problem to date and hasn't been a problem to date, and to try and look forward and look back and anticipate, well, what could go wrong? So what is it that might have me hold up in front of an Oireachtas committee? Or what is it that might have something that causes investors to lose out? What are the scenarios that causes that to happen? And then to think about those and think about, well, how do we stop that happening? So I thought it was good, and it was interesting to get yourself in that kind of position.
Yeah, and from the central bank's perspective, it's very important to recognise that Ireland has 55% of the domiciled ETFs in Europe. So there's huge risk to the central bank in terms of something happening which hasn't been thought about and damaging the brand and damaging the domicile. So to look under the hood, to check it and say, look, do we understand what's going on here? Are we happy with aspects of it? Are there things that can be improved? Is a very prudent way for the regulator to look at a market. But what was great from our perspective is the way that the central bank drew questions and ideas from papers in the US, in Canada, in Japan and various places, and particularly from IOSCO, and pulled it all together so that Ireland has become this kind of central linchpin to pulling it together a bit of global regulatory cooperation around how does this industry develop, what are the challenges for it, and you can see a sort of a worldwide homogenization happening across exchange traded funds, which is only to the benefit of investors in various jurisdictions.
Yeah, you can see, even if you look at the bibliography and the number of references and footnotes throughout the paper, that it is a deep piece that wasn't thrown together. There was a lot of you can see the amount of thought that went into the work, and it has put the regulator here in a position where they are in that sort of thought leadership position, and I think it adds to the depth of the work that's coming up from IOSCO, obviously, of ETFs and their agenda, that they're starting from a position that somebody's done a lot of the legwork, and you're bound to see similar themes being thought of and dealt with in the IOSCO work, because sort of the regulators' front-running piece has already sort of highlighted them as topics that maybe the industry and the regulators need to think about. In terms of the specific outcomes on share classes, so there will be a move to allow a single fund to have both exchange traded and non-exchange traded share classes. There'll be an ability for different cutoff times for hedged share classes, but no move on transparency. So that is still a requirement to make publicly available the full portfolio on a daily basis. You reasonably happy with that? Are you jumping out of your skin delighted? Are you crying at your pint? disappointed?
I think the share class piece is actually quite important, because a lot of people who are looking, what we have in the industry is we have platform proliferation, which is causing concerns for people that they have to go and build a new box with zero AUM, staff it, run it, and see what happens. So the ability to launch an exchange traded share class of an existing successful product with existing AUM levels is attractive for people. It's not without its challenges in terms of tax and other issues around it, but I think people will be able to build a scalable share class model, and we will see a number of those coming to market in the next year.
That soon, do you think?
That soon.
Right.
Soon.
And is that going to be, like, presumably you have to have a strategy that you can use in an ETF if you're going to bring it into an existing...
Yeah, it has to be ETF-able. It has to work in terms of positioning, it has to work in terms of product. But you have product manufacturers out there, if I can call asset managers that, product manufacturers who have hundreds of products. And if they go through their catalogue, they can find dozens which are eminently suitable to being in that box of being stands a chance of being a successful ETF product, and it allows them to tap the distribution model and tap the markets that prefer ETF product over non-ETF product. So it'll be very interesting to see how that develops and expands.
Well, I think you've just invented a new word there, ETF-able.
Yes.
Have you used it before? Because I've never heard it.
No.
Okay.
Here we go.
It's exclusive. Well, you've coined it, so you can claim the credit. On the transparency side, are you surprised? Are you bitterly disappointed? Is it a massive blow? Is it
There's
a
bigger picture at play here. I don't think the central bank could be seen to kind of go out on its own in terms of transparency and make bold statements in terms of changing a position. There are discussions going on at ESMA level. There are discussions going on at IOSCA level. Personally, I don't see the public policy reasons why, if I hold an S&P 500 unlisted, I get transparency once a month. As soon as if for example, if I hold a listed share class of that same fund, I'm suddenly supposed to get daily transparency on the underlying. I don't want it. I don't need it. And if I don't have it on one side, why should I have it by virtue of it being listed? Which is the industry comment that's been around for a long time. I think the position will change, and it'll change one of two ways. You either bring everyone up to the transparency standard, or you actually take you take the correct view that what we're having in terms of a transparency model for end investors works very, very well. It hasn't proven to be a problem that people need to absolutely understand what's under the hood, particularly for active strategies on a daily basis, and it's actually holding back the development and the push of active strategies into the ETF space, which fundamentally I think is in investors' interest, because it will lead to them getting better structured, more reasonably costed active exposures once that transparency differential is changed. But for now, it's same as it's unhelpful that we're getting different treatment in different jurisdictions. But from an Irish perspective, we are where we are. But I think it's something industry will be knocking on the door on for the next number of years, because it is hard to see a downside. Now, we always say that transparency is great and we shouldn't put that genie back in the box, but for certain active strategies and active managers, it's really important that they hold on to their secret sauce. Investors want that. Investors are paying for that. And as an investor, if I want a listed product, I want it active, and I absolutely want that manager to be able to provide that positive outperformance, then I'm quite happy for them to withhold transparency for a period of time.
I think it may well change. I think where a regulator needs to be comfortable is, the first question is, do I need transparency from an operational perspective to make the ETF work, particularly with the secondary market mechanism and with the authorised participants and the market makers? And if I do have to disclose it to them, is there a risk to my end investor that people in an intermediate role can take advantage of the knowledge that they have and that isn't being disclosed to the end investor and make a profit at the expense of the end investor? And I think it's maybe around there, and that might be an education piece and joining the dots from what a regulator knows to what the industry knows, because obviously the industry will know the ins and outs of the actual operations. But I have a sense that if those questions were answered, you're moving in probably closer.
And that's very interesting, because behind the scenes we've had discussions with a lot of active managers, and we've been very, very clear that there's a lot of product in the active space that is absolutely not suitable to be an ETF format. And it's because they don't even want the APs or market makers to know. Or even if the APs or market makers had the knowledge, they wouldn't be able to adjust their risk quick enough to have the spreads as narrow as they need to be for an exchange traded product. So to be clear, the market is almost self-regulating and self-clearing in terms of products which are suitable disclosure wise or not, because ultimately the person taking risk on exchange on a given day is the market maker. If the market maker can't get the information that he needs, or if the promoter doesn't want to give that information, then that product ultimately will not work and cannot work. And we have to sort of get to that point of monitoring to ensure that who is making a market, how often is that market being made, and how tight are the spreads during that period, and ensuring that people are in the market for as much as they can be on products. And once there's a commitment to be in the market there, you know that market maker who's taking on the risk is very, very comfortable that he can price the product.
Well, see, ideally as a regulator, you know your best solution is that the market regulates itself. But as a regulator, your question is, well, how will it regulate itself, or what will happen in times of stress when your interest is to serve yourself rather than necessarily the product or the investors that you're servicing? Anyway, can you tell me briefly, as you look forward for the next 12 months, maybe a little bit further, what you see in store for ETF industry? Obviously, the numbers are all very positive and the projections for growth are all very positive. Is there anything to doubt those?
There's nothing to doubt those. We've had 47 consecutive months of inflows into European ETFs and ETPs, which is phenomenal in terms of growth story. I think we do have a problem that too much of the inflows are going to one end of the market. There's a couple of players who are participating to a much greater degree in capturing net new assets or net new flows in that space. I think what we're going to see is a proliferation of legacy managers stepping off the fence and coming into the ETF space. We saw Legal & General, who purchased the Canvas platform from ETF Securities earlier in the year, come to market, and they've come to market with a series of core products, which is very much in their investors' interest. So they're launching 5 and 10 basis point products, and it's very much additive to their product offering for their clients. So you will see some of the Legal & General competitors look at that and say, okay, there is an angle here. They have a suite of product. They have an idea in terms of how they best provide that portfolio of exposures, that portfolio of product type, and that portfolio of costs to their end investors. You will see many follow that. So we can only see growth in the space. We can also only see growth globally. It's I was speaking to New York Stock Exchange 2 weeks ago at a sort of a global event on ETFs, and the one thing that kept coming up in conversations from other areas was the importance of UCITS ETFs globally going forward. The South American panel was very much talking about how European UCITS ETFs are being distributed primarily in their markets at the minute. Israel is a huge growth story for UCITS ETFs, and the Asian experience as well in terms of Singapore, Japan, and otherwise is about the acceptability of UCITS product in those markets. So certainly huge opportunity.
And what about the product type, the strategies involved, the underlying assets?
We are starting to see a move away, and I hate the term personally, smart beta, because it implies somehow there's a distinction from dumb beta. There's just beta that works and makes a return. But we are starting to see people look at active strategies and certainly more active product. People have missed the fact that PIMCO as a fixed income provider have 10 billion euros of active product in Europe at the minute, and that's kind of passed people by. So we're certainly seeing more active, and we're certainly seeing more thought out thematics and more thought out strategies, and people looking at their client base and looking at their product set and looking at their brand development in terms of what is their value add for their client, and can they build an ETF strategy around that, whether it's passive or active, and that is the move away from the large passive benchmarks and what I call bespoke content rather than sort of smart beta. We're starting seeing more bespoke content and people using and leveraging their brands. If I am a very big US house, I have a brand, I have a thematic, I have something I'm good at, and they're wrapping an ETF distribution strategy around that.
And one of the sort of the things identified as an emerging concern in the central bank's discussion paper was around a risk that the underlyings of the ETFs that the ETF providers might sort of stray into underlyings that were less liquid than the ETFs that are already there. Is that a valid concern? Are you seeing it that's not really emerging as a trend?
It's a huge concern, particularly as industries evolve, that people move into spaces they shouldn't be in, just trying to get ahead or trying to have a new angle to sell products to clients. So we'll kind of go back a few years to NUCITs, and you go back to kind of
NUCITs,
very structured payoffs going into UCITS and the UCIT derivatives to provide exposures which may have more risks attached to them that are not necessarily clear from the tin. So you're starting to see providers again self-policing and move away from volatility products and move towards more understandable products in the channels these things are going into, things that people can explain to their end investors. I think the industry is quite protective of the ETF brand as being sort of competitive, transparent, well-structured products that do exactly what they say on the tin. I don't think the industry will be happy if there's a move to more challenging asset classes within the ETF wrapper. We're quite lucky in that the UCITS framework puts a lot of restrictions on what we can and can't squeeze into it. There's much more of a sort of, the risky product goes more towards the ETP space, the structured notes that has always been there in terms of doing kind of highly levered or esoteric classes or property or things like that. So I think we're quite lucky. The UCITS framework is putting the handcuffs on, and then also the ability to market make a product that is key to people. And if it's difficult to market make, it's not going to go into ETF format because it is difficult to maintain a competitive listing on it, and there are breaches and regulatory headaches attached to it at an exchange or regulatory level when you have to explain why something isn't working. So I'm sort of confident that we're not going to stray into the sort of the 04, 5, 6 territory where we went into all types of things being shoved in because we could. I think as an industry we've learned now to step away from the sort of the investment banking approach of can you get it in, and more to the long-standing asset manager approach of is this additive to my clients and will it negatively impact my brand if it goes wrong.
So let's just change tack to wrap up. Adrian, talk to me a bit about your experiences with marketβeta for the last 10 months, is it? And what's the plans for the next 12 months?
We've had a very, very busy kickoff. In fact, when I joined marketβeta in February of this year, my plan was to have a sort of a quiet couple of months and work into the business plan and work into the business model and see where we go from there. Unfortunately for me, we actually hit the ground running, and we've had some very good conversations and some very good pieces of business from our client set, because everyone is interested in how do I build a successful, sustainable, multi-billion euro ETF platform, and bringing the kind of, as somebody joked, the brains trust within marketβeta to bear is very interesting, because you look at Graham, Joy, myself, others, everyone has been through at least 2 ETF successful platforms and launches, which brings a very kind of differing flavor of what you need to do to enter the space, be relevant, have a sustainable business model, and take part in the growth story. Again, the European space is littered with also-rans, and some people have been very successful, like the Source Now Invesco business, of stepping in and carving out a niche. So we've been having some very, very good conversations with our client base. It's been fun, it's been hard work, but certainly looking at our pipeline, there will be a proliferation of new entrants into the market in the next 12 to 18 months. People are getting serious about the space now. An ETF is just a wrapper, but is the wrapper of choice. And as people often say, when did you move away from a vanilla unit trust into a UCITS type model? It just happened over time. People always gravitate towards the product set that they think delivers the best optionality and the best results for them and their clients. And we're very excited.
Well, as I mentioned at the outset, Aquest is 1 year old this month. So happy birthday to me and to Aquest.
I'm liking your cake here.
So it's I'm not a serial entrepreneur. This is my first toe in the water. But it has been fun. It has been plenty of traveling and, foot shoe leather worn and that kind of stuff. But it's a great experience and something I am glad that I have done. And looking into year 2, you can sort of see that the seeds have been sown, I think, for, the brand is out there and that kind of stuff. So,
well, what's been interesting from my perspective, looking at you and looking at the development of the business, to a certain extent, it was a little bit of envy when I saw you step out. I was like, yeah, that's a huge gap in the market, and why hasn't anyone done that before?
Well, yeah, exactly, yeah. So don't tell anyone. Let's wrap it up there. As we do, I want to thank Adrian Mulryan from marketβeta for his time and his insights and his contributions. Thank you very much, Adrian. It's great to have you. Thank Gav Timlin from Create Sound for recording and editing the podcast. For everybody else, just to keep an eye out, there will be the November online tutorial from Aquest will be on UCITS performance fees. So we're going to look at the background performance fees generally, some of the terminology around equalization, high watermarks, that kind of stuff, but particularly look at the rules that apply to the use of performance fees and the central bank's recent letter to industry about their expectations, and try and pull all of those pieces together. So keep an eye out. That tutorial will take place later this month, and if you're interested in logging on for it, there is a free trial available through the website, so just take a look at the sign-in area. Thank you very much, and we'll catch you next time.
You've been listening to the Aquest Podcast. For information about our training and advisory programs or our academy, visit aquest.ie. For more resources on regs, funds, and governance, check out our YouTube channel, Daniel Lawler, RU, RQ.